Warren Buffett, the iconic investor, has just liquidated over $75 billion in his holdings, including significant amounts of Apple, one of his most substantial bets. At this moment, he holds the largest amount of cash in history. Berkshire Hathaway, his renowned holding company, now has an impressive $277 billion in liquidity. While we've seen a gradual increase in this amount throughout 2023 and 2024, the most recent data reveals a cash accumulation substantially higher than anything seen in the last 3 decades. Let's dive into this video to explore the essence of this perception, analyzing what this record cash allocation truly represents in relation to Warren Buffett's view of the economy and financial markets. At first glance, it's worth noting that in 2007, Warren Buffett also boasted a considerable cash reserve, just a year before the global financial crisis that saw U.S. stock markets plummet by an astonishing 60% due to a severe recession. During that time, Buffett began investing his resources in new opportunities, capturing stocks at bargain prices in 2009 and 2010. This suggests that Buffett had an understanding that eluded many. Again, at the end of 2021, his cash position was at historical levels before the market peaked and began a 20% decline. Once more, Buffett found a golden opportunity to allocate his resources into new assets. However, when we analyze the chart of cash allocation by Berkshire Hathaway, we realize it can be somewhat misleading. We can't just focus on the total amount. It's crucial to consider Buffett's cash allocation in relation to the size of his total investments. After all, Berkshire Hathaway's portfolio today is not the same as it was in the 1990s. Thus, the increase in cash may simply reflect the growth of Berkshire itself over time, not necessarily indicating an excessive cash allocation. Therefore, let's dissect this further. This chart illustrates Berkshire Hathaway's cash allocation as a percentage of total assets. And yes, it is evident that Warren Buffett has not only increased his cash allocation, but he has done so significantly over the last year in relation to his total assets. We can indeed assert that he has never had a cash allocation this high. However, it's worth noting that the last time his cash allocation was at similar levels was in January 2006, nearly 2 years before the global crisis. During that period, from January 2006 to the onset of the Great Recession, Buffett's cash allocation actually decreased as a percentage of his total assets. This suggests that Buffett was, in fact, ramping up his stock investments in the 2 years leading up to the global financial crisis. This perspective does not paint Buffett as someone who had prior knowledge of an impending issue in the financial system or who possessed insider information about a potential market collapse. Had he truly known about the global financial crisis in advance, the chart of his cash allocation would look very different. Another point to highlight is that Buffett had an extremely low cash position in the year 2000, which coincided exactly with the 50% correction in the U.S. stock market brought on by the 2001 recession. Again, had he anticipated an economic recession that year, his cash allocation would surely have been higher. However, Warren Buffett has never presented himself as a market prophet. He has always made it clear that he does not make investment decisions based on economic forecasts. He has even stated that any company hiring an economist is merely adding another employee to the payroll. Therefore, the current increase in Buffett's cash allocation does not imply that he is aware of some impending economic disaster. Rather, he is adopting this stance because he sees no attractive investment opportunities in the current stock market. In simple terms, he believes that most stocks are overvalued. In fact, one of his favorite valuation indicators is currently at alarming levels, the highest since 1947. This indicator, commonly known as the Buffett indicator, was mentioned by Warren Buffett as a simple way to assess the valuation of stock markets. It analyzes the relationship between the total market value of stocks and the GDP of the United States, essentially giving an idea of how overvalued the stock market is in comparison to the underlying economy. Presently, the Buffett indicator reveals that the market is more expensive than ever, resulting in a challenging scenario for investors like Warren Buffett, who seek opportunities. This is because Warren Buffett is a value investor. His investment philosophy can be summed up in the famous phrase, "Buy great companies at low prices." This approach, shaped by Buffett's mentor, Benjamin Graham, in the classic The Intelligent Investor, emphasizes that over time, the stock market oscillates between extremes of overvaluation, driven by investor greed, and undervaluation, resulting from fear. Graham teaches that the astute investor should seize low-price moments to acquire great companies at bargain prices and, when the market is excessively expensive, hold a larger cash allocation, waiting for better buying opportunities, especially when cash yields exceed those of stocks. Today, cash yields are around 5%, driven by rising interest rates from central banks, while S&P 500 profits offer about 3.6%. Graham argues that this is the ideal scenario for the savvy investor to increase their cash allocation, seeking to secure satisfactory long-term returns. However, as discussed throughout this video, we cannot conclude that this type of strategy will serve as a harbinger for the next big move in the stock market.